Welcome to this explainer. Today, we're going to build a really practical, step-by-step checklist to evaluate literally any IPO. And to do that, we're going to decode the upcoming SpaceX market debut. Look, if you've been watching the hype build for what might just be the biggest stock market debut in history on June 12th, you absolutely need a structured way to separate the noise from the actual numbers.
Okay, let's dive right into this by acknowledging an absolute reality. SpaceX is an extraordinary company. I mean, it launches more rockets than entire nations. Its satellite network spans over 160 countries. We aren't here to say the rockets won't fly, but we really need to figure out the difference between a great company and a great investment at its opening day price. Because those are two totally different things. And honestly, that gap, that's exactly where ordinary investors usually lose their money. To evaluate it properly, we're going to treat this IPO like a complex machine and run it through 5 crucial metrics. The day one illusion, unpacking the profit engine, the valuation multiplier, hidden supply waves, and finally, the expectations test. Let's get to it.
Metric number 1, the day one illusion.
This is all about the front of the line versus the retail reality. So in any IPO, there are actually 2 very different prices. You've got the $135 IPO price, and then you have the elevated open market price. The banks, the insiders, they quietly lock in that $135 VIP price before trading even begins. They are essentially at the front of the line. Meanwhile, you, sitting at home, you're likely going to pay a much higher, hyped-up open market price simply because the demand completely outstrips the supply. Even if they allocate a larger slice to everyday investors, most folks end up paying that elevated price the literal second the market opens.
And hey, if you think that day one pop is proof that you need to buy in immediately, just consider how Rivian and Reddit performed over time. Rivian had this incredibly hot opening day. It jumped 22% right out of the gate. But then, it fell 67% over the next year. Reddit, on the other hand, did the exact opposite. It looked like a total flop on day one, but then it climbed 150% later on. So the crucial takeaway here is that the excitement you feel watching that ticker jump, it's just noise. It's not information. The first day tells you absolutely nothing about the long-term viability of the investment.
Moving on to metric 2, unpacking the profit engine. Time to look under the hood of all this hype.
Well, before we even check the price tag, we have to look at the actual business numbers from their own 2025 filing. And wow, the numbers are staggering, but maybe not in the way you'd expect. Yes, they brought in a massive $18.7 billion in revenue. That is a seriously large business, but you know the headline you definitely won't see plastered everywhere? They actually lost $4.9 billion overall that same year.
So we really have to break that down further. Most of us think of SpaceX as, purely a rocket company. But when you look at the revenue breakdown, 61% of that revenue, roughly $11.4 billion, comes from Starlink, their satellite internet service. And here's the real kicker. Starlink is the only part generating any meaningful profit, bringing in about $4.4 billion in operating income. The rockets, they're growing pretty slowly, and that newly folded-in AI division is basically just burning cash right now.
Think about it like this. When you buy a share of SpaceX, you really need to understand the mechanics of what you're actually holding. You aren't just buying a fleet of rockets. You're buying one highly profitable engine, Starlink, that is literally towing several heavy, money-losing cars behind it. Now, yes, there's definitely a case that those other cars become valuable someday, but as we're about to see, the price of this stock is being set as if someday is already here.
Which brings us perfectly to metric 3, the valuation multiplier. Or, as I like to call it, the price of the story.
To really understand the level of hype we're dealing with, we have to measure the actual weight of their massive $1.75 trillion valuation. What that means is you are paying roughly $94 for every single dollar of revenue. 94 to 1. And here's what's absolutely wild about that. This multiple is being applied to a business that is, as we just saw, currently losing money overall. To put that into perspective, established, highly profitable tech companies usually trade in the low single to maybe low double digits. A 94 to 1 multiple is almost unprecedented to sustain. And guess what? The market actually knows this. Consider that just months prior, in the middle of 2025, private sales valued SpaceX around $400 billion. Independent Wall Street research actually pegged the realistic value at roughly $780 billion. That's about 55% below the public going price. The entire incredible run-up to $1.75 trillion happened in a short 11-month window, right before you were invited to the table. The business itself didn't quadruple in size, the price of the story did.
All right, metric 4, the hidden supply waves. This is the great IPO relay race.
So you absolutely need to know this term, exit liquidity. It's not a glamorous term. When a massive company goes public, big index funds inside millions of retirement accounts are often forced to buy the stock automatically just to track the market. This forced buying artificially props up the price. And who does that benefit? Well, it creates a perfect, elevated launch ramp for the insiders, the ones who bought in early at $135 to sell their shares. The risk basically gets passed like a baton from the insiders directly to the late-coming retail buyer. It turns ordinary investors into exit liquidity.
This dynamic creates a very real danger zone. Normally, an IPO has a single lockup expiration where insiders can finally sell, but SpaceX is trickier. They have a series of, well, timed damn releases. Just a few months after the June 12th debut, right after their first public quarterly report, the first massive wave of insider shares hits the market. Then more tranches free up intermittently leading all the way to the 6-month mark. This means relentless waves of fresh insider supply will flood the market precisely when the initial retail hype begins to fade, which naturally pushes the price down.
And that brings us to our final and most important metric, the expectations test. Time to do the cold, hard math.
Ultimately, this all comes down to taking the emotion entirely out of the deal. We have to ask, what must this company achieve just to make your investment worth it? Let's walk through it. Step 1. Let's target a super boring, lazy 10% annual return. Basically what you'd get from just sitting in a standard index fund. Step 2. Starting from that $1.75 trillion, SpaceX has to balloon to a $4.5 trillion valuation in 10 years just to match that 10% return. Step 3. To actually justify that value, they would need roughly $566 billion in annual revenue. And step 4, the real reality check. To get from $18.7 billion today to $566 billion, they must execute a 41% year-over-year revenue growth every single year for a decade straight, without stumbling even once.
I really want you to grasp the sheer magnitude of that math. This 41% year-over-year growth isn't starting from some couple guys in a garage baseline. It's starting from an almost $19 billion base. That is a faster growth rate, maintained for a longer continuous period than almost any technology giant in history has ever managed during its very best decade. And remember, this Herculean, basically near miraculous result, it's required just for you to break even against doing absolutely nothing and leaving your money in an index fund.
So, what is the practical takeaway for your IPO checklist? It's really straightforward. Let time do the work. Don't chase that day one pop. Wait for real, public quarterly results so you can actually hold the company to hard numbers. Let the forced index buying run its course and allow those tricky, timed insider lockup waves to wash completely through the market. Listen, the market rewards the patient far more than the early. Wait to buy at a price grounded in reality, not one dictated by a hype-filled countdown clock.
As the clock ticks down to June 12th, or honestly, whenever you look at the next massive IPO, I want you to keep this final question in the back of your mind. Apply this exact expectations test to any future deal you consider. Great companies can have terrible opening prices because the miracle is already fully priced into the script. So ask yourself, are you paying for a real business or are you just paying for a story? Don't mistake loud noise for a reason to buy. Thanks for joining me for this explainer. Keep your checklist handy, and I'll see you next time.